smaller companies are probably down 20%. So we've got a narrowing of the market. You know, your Apples, your Facebooks, your Googles, and that's also a sign of kind of an end of a bull market where the market starts to get very narrow. And we see in a bear market, we see the correlation from one stock to another actually all come into one, where it doesn't matter about what the company is doing. It's just more about people panicking and selling. So you see all the stocks starting to move down together. So we'll be watching that. So as far as recoveries and timing things, I'll do that more in future videos. There is a return. Get it here. So this is the monthly ROC, rate of change. You can just Google if you want the formula. It's fairly straightforward. It's just comparing price periods from now to 12 months ago. But this has been very good. Basically, it's an oscillator. And when it goes above 20, then comes back below 20, and then crosses the zero line, it's usually a start of a possible correction. And we could see that happen back in 2009. We're up here at 20. We went all the way back down to minus 40. And then when it comes back across 20, like negative 20, that's usually a good buy signal. And you can see here, you would have captured pretty much all of this bull run if you would have started buying there. And if you would have actually sold when it got down even here to minus 20, you would have missed a lot of the downside. So this is not really giving a clear signal right now. I don't pay attention to this rate of change at the beginning of a bull market because it can give you a kind of a false reading, but it becomes more important towards an end. And now it has gone, it was high as 30, and then we're down to 5. So if I see this cross 0, and then I'd want to see it almost go to minus 20, maybe it goes down to minus 30, and then you start to see it recover, maybe at minus 20 again, that's when you start buying again. And this has been accurate for, I don't know, 40, 50, 60 years. And if we do get a correction similar to 2009, I've done a measurement here, and we're at, we got up to about 3,200, now we're down to 2954 on the S&P, but we really could come all the way down to 1674, so I mean another well over 1,000 points we could easily come to. And usually using a little bit of Elliott wave, but usually there's like a 1, 2, 3, 4, 5 is the final leg, and then a bear market will take you back to the 4th level. And if you kind of look at this, we could easily come back to the support level back in 2015, and that's around 2,000 points. So that's still another 900 points where we could come down. So that's why I'm being fairly cautious. It's just way too early to determine what's really going on. And last week was just such a rapid drop that just made no sense to me to stay long. Also, some of the commodities are looking like copper's back to a low. West Texas Intermediate hit 45. It was already low when it was at 55.60. So the commodity markets are kind of looking out pretty far now and expecting some bad things, especially for oil. And OPEC's even cut oil production, but it's not having an effect. So again, that's another indicator to start to look at. If commodity prices firm up, start coming up, especially copper, another indication that things are maybe turning around. But I expect to see a lot more guidance down in earnings, which is going to affect the stock, especially the high flyers. The data that's coming out of China will be coming out of the States soon, the PMI numbers, all that type of thing, which I do follow and I will update. But that's all going to be negative and could stay negative for who knows next. Again, we just don't know. So anyways, that's a 3-part video this week. That's it for now, and I'll try to put something out next week. Thank you. Bye.